motivation, followed by the model that we are using. It's a pretty simple, actually, pretty simple ex-ante screening model with costly and hidden effort. And we are using this to talk a little bit about how so-called tranche retention requirements can or cannot be used to fix incentives in securitization. I'll give the model mechanics, results, at least a little bit, and then go into findings and implications, including for policy. By way of motivation, I've got a few numbers here on securitization markets in Europe and the US combined. The key takeaway, I'm not going to spend much time on this, is basically that a $2 trillion plus market collapsed going into the crisis. We can see this here. There's a bit of life towards the end of the period, usually in response to government intervention, all those four-letter acronym programs that you've heard about. But I think pretty much everybody would agree that the market remains in the doldrums, and that has triggered quite an active discussion about how to revive the market. And before I move on, just one additional observation. The difference between the red line, which has the totals, and the actual bars is what's called retained issuance, so-called retained issuance in Europe, which is stuff that is exclusively done for the purpose of refinancing with the ECB and the Bank of England. So it's not actually marketed volumes in that sense. It gives you an even stronger sense of how bad the market is doing, relative certainly to the past, the pre-crisis situation. Now, I mentioned a discussion about measures to revive the market that has conjunctural as well as structural aspects. I'm not going to talk about the conjuncture. The focus here is on structural measures, and there is pretty widespread agreement that a number of structural flaws in the market have been kind of surfaced by the crisis. And I have some things here which are pretty well-trodden ground. The idea to have less, at least on average, like less complex securitizations, to provide more transparency, in particular at the individual asset level or when it comes to the cash flow models that are being used and stuff like this. And then finally, measures to reduce the reliance on hopefully improved ratings. All this goes under the headline of improving market discipline and thereby possibly reviving investor interest, kind of tap the existing investor base. But the question is, what's going to happen if all this is not going to do the trick? And that has raised, again, a very active discussion about ways to fix incentives directly along the securitization chain, which can be rather long if you think about subprime US mortgage securitizations, for example. And kind of the main proposal that has been tabled here and that is very actively discussed both in Europe and in the US, I guess we'll hear about that from Stas in a couple of minutes, is the idea of skin in the game legislation, forcing originators or sponsors to retain an economic interest in the structures that they generate. And kind of interestingly, at least up to very recently, the focus of this discussion has been on equity tranche retention. There are kind of two reasons for this. The first reason is that it's kind of rooted in the existing contracting literature. I'm going to come back to that in a minute. The other reason is, I guess, that it's kind of, or it seems kind of obvious. The equity tranche is the first loss piece. It's going to take the first losses by definition. That makes it the most risky piece, and therefore it's a good idea to have the originator hold on to it. No, it's actually pretty easy to come up, at least like in theory, with counterexamples. One would be to think about an asset pool that has assets with very backloaded default profiles. If you have that and your equity tranche is relatively thin, then you can break even on your equity tranche, even if eventually you might be wiped out by losses on the pool. And that then obviously is not going to align incentives. And then in practice, you've got things like turbo amortization of the equity tranche that can get into the way even more. So there are issues here with equity tranche retention, at least potentially. And that means that we have to consider other retention mechanisms, and we look at three of them here in that paper: equity versus what we call a mezzanine tranche, and then a so-called vertical slice. And I have this beautiful slide here that is supposed to discuss a little bit the tranching mechanism. I have a long story to tell on that. I won't have the time, and for this audience maybe it's not required. The main point is that this year is what we think about when we say vertical slice. It's really a share in the underlying portfolio that cuts through the existing capital structure. And the other takeaways are that cash flows come in from the top of the structure, losses feed in from the bottom of the structure. That's how the mechanism works. Another way to look at the same thing is in terms of loss distributions, and this is just an arbitrary one for illustration purposes. Basically what happens is that the loss distribution is being sliced and then allocated across the various tranches. Given that the tranches are defined in nominal volume terms, changes in the loss distribution are going to reallocate probability mass across the tranches, changing the riskiness. And what's going to do? What's going to drive this sort of behavior? Well, on the one hand side, you can have things going on with asset pool characteristics. Key example here would be default correlation. That's known. If default correlation rises, it's going to push probability mass into the tails of the distribution. But something that's also going to be important is underwriting quality, because underwriting quality relative to the accepted standard, past experience and all this, is going to affect the shape of the loss distribution. And then things affecting underwriting quality, such as retention mechanism, can actually affect the loss distribution. That's the kind of the idea behind the paper and behind these regulatory proposals. Few words on the related literature. Again, I'm not going to have time to cover this in any detail. The paper most closely related to ours in spirit is Enos's 1990 JET paper. He basically proves that the optimal financing contract in what I would call like project finance is standard debt. A key driver of that result is a technical regularity condition known as MLRP, the monotone likelihood ratio property. And what Chiesa does in another context is she shows, and others have done that before, that taking MLRP away, you can get other solutions. What the Enos paper is basically saying in structured finance terms is that you should retain equity, and we kind of challenge that conventional wisdom in what we do by taking MLRP away from the model, from a very simple model. I'm not going to talk about that. So what is it that we do in the paper? The main questions are as follows. What is the impact of different retention mechanisms on screening effort? And then on that basis, are there mechanisms that dominate the others, and what are the conditions driving that? The answers, just to give you a preview, are as follows. First of all, the impact of any retention mechanism depends on its sensitivity, what we call the systematic risk factor, some proxy for the cycle, very simple proxy for the cycle. And on that basis, it's indeed the case that the equity tranche can be dominated by other retention mechanisms. And in short, one way to summarize this is that there is no one-size-fits-all retention mechanism that you can use to fix the market. Because kind of the optimal tranche size and the optimal tranche location is going to depend on a lot of things, the specifics of the deal, position in the cycle, and so on. Another way of thinking about this is that nominal tranche size is not the right metric to define retention mechanisms. You would probably need something like nominal tranche size over expected loss, and that raises all sorts of other issues. So, well, I'll come back to that if I have time. Now, turning to the model as such, again, it's a screening model. We are looking at the decision problem of an originator who generates a loan pool for the purpose of either retaining it on balance sheet or securitizing at least part of it, part meaning that there is a retention of parts of the structure. We start out with kind of a cash endowment of Z, which is being translated into Z loans of 1 unit each. Model setup is very simplistic, no discounting or anything. Risk-free rates are set to 0. There are kind of 2 outcomes as far as the loan is concerned. The one is a repayment of a fixed return R, or we have a 0 recovery in case of a default event. 2 types of borrowers are being considered, good and bad ones. Bad borrowers have negative net present value. In other words, I wouldn't want to lend to them if I was able to tell their type. And I can tell their type only via screening. Screening affects the percentage of borrowers in the pool, but it's costly. And again, I'm going to come back to that. This is where the systematic risk factor comes in. There are 3 factors or sets of factors that will drive pool loss. in this context. First of all, we have borrower PDs across the two states of nature that we consider and across the two borrower types. That makes like 4 PDs, and we make a couple of simplifying assumptions to keep things straightforward. Secondly, we've got the systematic risk factor, which will determine the state, one of the two states. And then finally, we have screening effort. Screening effort is going to determine the composition of the loan pool, and all this taken together gives you, quote unquote, your loss distribution that you are working with. Another assumption that we make, again for simplicity, is that Z, the pool size, is very large, highly granular pool. In other words, we can assume idiosyncratic risk away, and we don't have to get into the specifics that you tend to get in credit portfolio modeling, portfolio credit risk modeling, namely this interaction kind of between idiosyncratic risk and systematic risk that you would get in CDO pricing, for example. We work just with the means. That makes things simple. Screening, again, it affects the proportion of good borrowers in the population in a linear fashion, as you can see here. Cost of screening, we assume a convex technology here. That's kind of standard in the literature, and we needed to get sensible results. You can debate this. And then finally, a way to think about screening is basically flipping PDs. The more I screen, the more I exchange good borrower PDs for bad borrower PDs in the pool. And the way to write up the value of screening across the two states of nature is in terms of these delta parameters that basically have the difference of the two PDs. So far, I haven't talked about securitization, largely because there is no reason to securitize in our model setup, given that it's so simplistic. We have to introduce this somehow, and we think about this in two ways. First of all, it's what we term direct benefits. There is a huge literature suggesting that market frictions can make external funds costly, and kind of, again, translated into a securitization kind of thinking, it means that upfront cash that is generated from securitizations can be valuable for the originator because of these frictions. In addition, and this is something that was very important during the crisis, there can be all sorts of reasons to generate indirect benefits. To the extent that there is capital regulation, capital can be freed up, reemployed. You can have effects coming out of accounting, upfront recognition of profits and things like this. And you can have remuneration systems at the originating firm having an effect to the extent that they reward volume over quality or something like that. So we take all this, stick it into a single parameter that we call omega, and we assume it to be bigger than 1. So in economic terms, for the originator, the net present value of the cash flow, the upfront cash flow, that is generated through securitization is being increased by that factor. The value is higher than the net present value of these cash flows. Okay, some more assumptions to kind of close the model. Screening effort is non-verifiable, non-contractable, and the timing structure is set up in that way. We have competitive investors. They understand everything. They understand the decision problem. The only thing they don't know is the screening effort. Retention is being imposed for most parts of the paper. And then we basically compare the different mechanisms with each other. There is a section in the paper later on that we are still working on that gets into the choice that the originator would make if he were able to choose different retention mechanisms. And we find that, making some assumptions, that there might be a reason for regulation here. They may choose, quote unquote, socially suboptimal retention regimes. And then finally, all this is a one-shot game, no reputation effects, partially to keep it simple, partially because we believe that reputation is not a good fix for incentives. We can talk about that. Now, this is the model as such. All this translates into a very straightforward profit or revenue maximization problem. We have the cash flows generated from securitization up there. We have the cash flows generated from any retained bit of the securitization. We have screening costs, and then the costs of our initial endowment. Those will drop out later. And we start out by looking at two kind of reference cases. The first one is what we call the benchmark case. It's the case without securitization. The full retention case. Everything remains on balance sheet. Incentives obviously are perfectly aligned, and what we end up with is first best effort. I'll get back to that in a minute. And then we have the second extreme case of no retention, and given the setup of our model, the one-shot game nature and all that good stuff, basically the outcome is going to be zero screening. So we have basically that range of outcomes that you can get in the model. This is just the details on the first case, the benchmark case. We stick in our state probabilities. We stick in the survival probabilities of the various fractions of borrowers in the pool, and those fractions alpha depend on the screening effort. Now, what we get is a first order condition. We can stick in our delta parameters. And that condition is going to define benchmark effort. Again, very straightforward, no big surprises here. You should raise effort up to the point where marginal costs equal marginal benefits, where marginal benefits are defined by the value of screening in the two different states of nature, weighted with the state probabilities. That's your benchmark effort. And do the same thing for the other case. I'm not going to talk about this. From here onward, I'll talk about the model mechanics in terms of diagrams like this to basically avoid the tedious algebra. And this should look familiar, at least the red line, because the red line is the standard payoff profile for a standard debt contract. And we look at three retention mechanisms here from the investor side. So the red line gives you the investor side of a case where the originator holds the equity tranche, and we subsume all the other tranches. So mezzanine and senior is the same thing for the purpose of these graphs. And then we end up with a standard debt contract. The more cash flows are being generated, these are being translated one-to-one into payments for the investors up to the point B1 where they are being repaid, and then everything else is being captured by the originator who holds on to the equity tranche. That's the red line. And kind of similar stories can be told for the other retention mechanisms. The flip side of this is the originator side. And again, the equity tranche retention case is the red line. And here, basically, nothing is going to accrue on the originator side up to the point where the investors have been repaid, and then one by one we get this translation into payments for the originator. Now, one case, the interesting case in our paper that we spend most of our time on is the so-called thin equity tranche case, or the case E1. This is what we term it in the paper, where the equity tranche is thin enough to be fully exhausted in the low state of nature. If you get that in terms of this diagram, basically your low state realizations are to the left of this kink in the payoff functions. And what we see here is that an increase in effort, which would translate into these little, the realizations, the dots shifting to the right for both states of nature, doesn't generate any benefits under equity tranche retention for the low state of nature for the originator. And that then, in model terms, translates into a first order condition that has kind of two parts. We have two truncated first order conditions with a discontinuity at a certain level of effort. And in something that we call the high marginal cost case at the effort level of E hat, we end up in a situation where the first part of this first order condition works. And here only the parameters for the high state of nature are going to influence the decision on effort. And that then means that the equity tranche can indeed be dominated. It's pretty straightforward. You can evaluate this. You can derive conditions under which the equity tranche dominates mezzanine or the vertical slice. And what's going to be important here is the probability for the high state of nature, the value of screening, or the impact of screening in the high state of nature. And another way of looking at this is that the higher pH, the more likely the equity tranche is to dominate. And that basically means that the equity tranche is a good fair weather device, but maybe a less effective retention regime if you are heading into a downturn. That's kind of one of the messages coming out of this. This is just the other case that we are looking at for the thick equity tranche. The key feature here is that all state realizations are to the right of the kinks in the payoff function, and then you can see the slope for the equity tranche, for the payoff function of the equity tranche, is highest across all states of nature, and therefore you end up in the benchmark case. perfectly aligned incentives, and kind of optimum effort levels. We do some comparative statics to get a feel for the parameters. I'm just going to show one of this in the form of a graph. This is the vertical tranche size that you would need to dominate, and that would be the red line, either the equity tranche retention scheme or the mezzanine tranche retention scheme, depending on the state probability pH. And we can see that as the state probability rises, it's getting more difficult to dominate the equity tranche for the vertical slice. That's the red line. You need an ever higher vertical slice to dominate. And it's the other way around for mezzanine. An implication of this is that vertical kind of sits in the middle. It's unlikely to dominate both of the other regimes at the same time. I mentioned this. I'm not going to have time to cover this. We look at this originator choice of retention mechanism. It's possible to construct cases of suboptimal choices, and that may be a reason for regulators to come in. We also plan to look at disclosure, kind of take the knowledge about retention away from the investor, and that will probably mean that the whole thing collapses and you will end up, at least in our model, with the no retention case. I'm being told that I have to rush. So I'm going to get into findings and implications. Main finding, there is no one size fits all that is going to fix incentives across all types of securitizations, because, as already mentioned, nominal tranche size is not the right metric to do this. You need something that's risk adjusted, and that raises all sorts of technical issues. What can you do? Well, one possibility would be to have a flexible retention requirement, give people an option. That's kind of the European way of thinking about things. That's what they have decided to do. There are issues with this, at least to the extent that you don't have mandatory disclosures of what is being retained and where in the capital structure. And once you think about this, possibly the mandatory disclosures are going to do the job, because you'll be able to tell what's being retained and where. And that then can be appropriately priced. Another thing, given again that it's difficult to make this stick, that to kind of right size the retention requirement, you may want to attack this at the source, not via retention requirements, but by fixing some of the reasons why we see misaligned incentives. And that would mean deal with accounting rules, gains on sale, deal with remuneration systems that reward volume rather than quality. Think about the regulatory parameter, make sure that everybody along the securitization chain is somehow being regulated and supervised, and things like this. And this is where I'll stop.